The two true wealth building assets are stocks and property because they both pay a rise in income and have a rise in capital value over time. Property is a tried and tested approach to get into financial independence and is one of the most common approaches, along with index fund investing in the FI community. But often, people either seem firmly to sit in one camp or the other. I have always approached it from a different angle and see that they can both complement each other and come with their own benefits and disadvantages. I have recently refinanced my buy-to-let property and I've been looking at the returns. Now I have a few years of costs and income data to analyse, and I was actually surprised by the results. So let's have a look at how it compares to my Vanguard ISA and how I see the potential returns playing out moving forward. First, let's look at index fund investing. I'm a big believer in owning the great businesses of the world via a low-cost global fund. In my stocks and shares ISA, I invest in the FTSE Developed World UCITS ETF as my global tracker. This fund invests in the FTSE Developed Index comprised of large and mid-sized company stocks in developed markets. This is pretty much as set and forget as it comes, with the odd bit of work required to reinvest dividends 4 times a year. Too much hassle? Then you could opt for something like the FTSE Global All Cap Index Fund, which has accumulating units, so no need to even log in to reinvest the dividends. The historical return of global equities has been roughly around 10% per year. Many experts are suggesting that there is currently lower expected future returns at the moment, but who knows? So I'm going to use a 10% annualised return to benchmark the buy-to-let property against. So on to the property returns. Firstly, a little bit about the property. It's a 2-bed apartment in a small block in a desirable part of Nottingham, a short walk away from the city centre, and typically rents to professional tenants for around £1,000 per month. I've just refinanced this property onto a 5-year fixed 75% loan-to-value interest-only mortgage at an interest rate of just over 2%. As part of the refinancing process, a valuation was produced by a surveyor of £220,000. Therefore, based on this valuation, the property has approximately £55,000 in equity. Rental profit. Income generated through rent over the year is around £12,000. The annual costs based on my experience and allowances are as follows. Mortgage interest of around £3,800. This property is fully managed, so I pay a lettings agent's fee of around £1,700. Other bills and charges, including insurances, service charges and maintenance, etc., of around £2,100. An allowance for void periods in between tenancies of 1 month's rent. I have only had 1 month's vacancy in 2 years so far, but I think it's sensible to assume the worst case scenario. Therefore, I estimate total cost per year to be around £8,600, leaving a rental profit excluding tax of roughly £3,400, which equates to a return on investment of around 6.2% per year. To get the total return, we need to look at the potential increase in capital value as well. Savills recently produced their UK house price forecast and are predicting around 21% growth from 2021 to 2025 for the UK on average, and 24% for the East Midlands. But to be a bit more conservative, I'm going to use a 3% increase in capital value each year. So at 3% growth per year, the property value 5 years on would have increased from roughly £220,000 to £255,000. So when looking at total return, 5 years rental profit should be around £17,000 and the remaining equity should be around £90,000, which results in a final value of around £107,000. This number doesn't factor in taxes or any potential rent increases though. Comparing this to just investing the £55,000 of equity in a global tracker, compounding at 10% and doing nothing, it would leave you with a pot of around £88,000. I thought the property would have outperformed by a lot more, to be honest, before looking at the numbers, especially for the amount of hassle and risk that taking on a rental property entails. But I basically just bought a recently refurbished property in a desirable area and have it fully managed by a letting agent. There are a number of ways to get much higher returns and to spread your cash further by adding value and refinancing the money out to fund the next purchase, etc. But when I purchased this property, I didn't really have the time or inclination to do anything hands-on. In the future, when I live closer to my investment area, I would look to go down a more hands-on route to hopefully achieve higher returns. I can definitely see the potential in using property to quickly build wealth in the early years by using high amounts of leverage, especially if you have the right skill set and knowledge. But property investing is a mini business in itself, and with ever-increasing regulation, it needs to be treated as such. I do sometimes consider liquidating my whole portfolio, leveraging up and going all in on property investment for a 10 to 20 year period before shifting back towards index funds again later on, which I think would produce much better returns in terms of wealth generation over time, but equally with a lot more risk, time and effort. As always, there's no free lunch in investing.